Joining us on the line today again with the third session in out of 3 sessions for our annual JSE Sustainability Showcase. Very, very glad to have all of you today. Thank you for making time and staying with us. I think today's lineup is exceptionally exciting, relating to a topic that is going to become even more relevant for a country like South Africa, but also nascent in its stages. So without further ado, I'm going to hand over to our CEO, Dr. Leila Fourie, to do the welcome before we kick off the rest of the day's proceedings. Over to you, Leila. Thank you.
A very warm welcome to this exciting, timely, and very topical Transition Finance Symposium. A big thank you to our partners in this event, the IFC and the GIZ, whose support have made this event possible. This session forms part of our annual Sustainability Showcase, which kicked off yesterday with a series of company showcases and a panel discussion on climate risk and opportunity. This sets the scene for today's critical conversations on transition finance. The impact of climate change is already being felt in South Africa, with temperatures, dry spells, and extreme weather events on the rise. Like many other nations, South Africa is paying increasing attention to climate change-related risks and opportunities. The country's reliance on fossil fuels increases the relevance and difficulties, both economic and social, of a transition towards sustainable economic growth. The implications for financial markets have taken center stage in the work of National Treasury, most notably in its 2020 paper on financing a sustainable economy and the resulting establishment of several working groups. One of these, the Sustainable Finance Working Group, is chaired by the JSE, and it includes a section on the implications and imperatives of a just transition. The JSE has made significant efforts to increase the enabling environment for better sustainability practices and disclosure to grow. We were among the first emerging markets in the world to establish a dedicated platform for the listing of green bonds and we expanded that to include social and sustainability bonds in 2020. This year, we saw a number of social bonds listed on the JSE, as well as the first self-labeled sustainability-linked bonds on the continent. Uptake on this segment has been very encouraging, and we're inspired by the key developmental needs and that these capital raises are funding. The current tally of bonds raised on our sustainability segment is just over $1 billion or around 15 billion South African rands. So it's no surprise that our suite of sustainability products continues to grow. This year, we will expand the sustainability segment to include sustainability-linked bonds as well as transition bonds, both of which are planned to go live before year-end and pending regulatory approval. While the focus in many jurisdictions has primarily been on green finance, it is transition finance that will be of great importance to the real economy in many countries. For a country like South Africa, where both the energy system and the economy are coal-intensive, the financing of a shift to an environmentally and socially sustainable economy is especially important. The transition is essential to ensure that moving away from high carbon industries is done in a way that builds skills and creates jobs for those people in those industries. Transition finance allows companies to participate in a sustainable future by developing timelines, targets, and bold commitments to the transition on specific sustainable development goals. In the short term, definitions, policies, regulatory measures, and products need to be determined. In order to do so, inputs and coordination between policymakers, regulators, and financial market participants and the corporate sector are necessary. As we embark on this path, complex questions will arise, many of which have become more urgent in the face of the COVID-19 pandemic. How can a just and inclusive transition be achieved? Which measures can be leveraged to ensure transparent disclosure? How can a common language and understanding of transition finance be generated and misconduct be prevented? What are the individual value propositions? This symposium, organized jointly by the JSE, IFC, and with support from GIZ, brings together domestic and international perspectives and experiences from policymakers, capital markets professionals, such as stock exchanges, investors, issuers, and banks. It's an opportunity to hear firsthand about respective priorities, to debate the business case for transition finance, and to delve into best practices, risks, and opportunities. I'm certain that you will find this content exciting and valuable, but I also hope that it will inspire action and more robust inputs into the shaping of these developments globally and locally. We're on the eve of the COP26, largely being touted by the being touted as the finance COP, where matters of financing the just transition will be top of mind. Today's discussions should help us to understand the role of finance and the transition of finance better. Thank you again all so much for attending, and I wish you fruitful and insightful deliberations.
Thank you very, very much, Leila, for that introduction. And I think you've already set the scene for those who are wondering what transition finance might be and what could be in store today. I think Leila's given us a really good view. I have been remiss in not introducing myself. My name is Shamila Subramani. I am the Chief Sustainability Officer of the Johannesburg Stock Exchange. I am standing in as MC this morning until our MC can join us. Our MC for this morning was meant to be Louise Gardner, and she will join us a little bit later, and Malango will take over shortly once we've finished the first segment. So I believe that we do need to test first. So if you could bear with us for a second before I introduce our first speaker. This is the joys of living in the virtual world right now. I could hand over to the test team, please, if we could just check if Malango is available. Malango, you're on mute tonight. Okay, there we go. Fantastic. Malango, you are live and we can see you. So if you could just say a few words.
Hi, everyone. Can you hear me clearly?
Fantastic on my side, yeah.
Okay, I just want to thank everyone for joining this session and to introduce our first speaker, keynote speaker who is Vukile Davidson from National Treasury. He's the Chief Director in the Financial Sector Planning Unit. And he's going to speak today about the work that the National Treasury is involved in related to sustainable finance issues more broadly, but in particular issues related to the transition, since we're speaking about transition finance. So thanks very much, Vukile, and over to you.
Morning, and thank you for inviting me today. Just to start with the quick disclaimer, the comments that I will make today are my own and should in no way be assigned to the National Treasury, Minister of Finance, or South African government. So this conference focuses on sharing of experiences of JSE-listed firms in contributing to the transition to a low-carbon economy. In a sense, these companies have spoken about how to ensure sustainability in order to preserve shareholder value. And this is where I would like to start today. I'll speak a little bit about how we think about value and values in the financial system and more broadly. Most of you would have done some economics at university. In your studies, many of you would have understood that the best economic outcomes are driven by rational self-interest. This concept is most elegantly captured in what Mark Carney describes as the most widely cited and yet least read economic text, Adam Smith's Wealth of Nations. In it, Adam Smith describes self-interest as a force by which individuals maximizing their interests and in so doing maximizing social welfare as the invisible hand. The idea has come to dominate economic teaching, particularly since the 1950s. In this paradigm, a thing has value because of its price. The value of the inputs needed to create it are determined by the price. For example, labor and land's value is determined by the price of the good ultimately being produced. This is in contrast to the idea where the price of the inputs determine the value. This classical idea has led to the idea that markets are the most important aspects in economic interactions and determining value. Indeed, even when markets lead to suboptimal outcomes, for classicists, more markets are often cited as the solution. The idea of the supreme wisdom of the markets was a significant contributor to the over-reliance in market indicators, rating agencies, and innovation, and the subordinated role of regulation that ultimately led to the 2008 global financial crisis. Of course, the irony was that Adam Smith was a social philosopher who was interested in economics and not the other way around. In Adam Smith's less known but seminal work, A Theory of Moral Sentiments, Smith places social interactions at the core of economics, not their individual. Broadly speaking, Smith recognizes that economic activity relies on social interactions, and that social interactions are governed by morals. The driver of economics, therefore, is determined by social values, moral and ethical. What is required is a cooperation or collective action needed to solve the most complex economic problems, as described by Nobel Prize economist Elinor Ostrom. When society sets a clear goal, which is usually done on the basis of social value, it becomes profitable to align to that goal and costly to operate outside of it. So why do I bring this up? And how does this relate to sustainable finance? The climate crisis is a consequence of our past economic activity and paradigms. Our ability to meet this challenge will lie in how we arrange our economic activities in the future. In short, we need to align social values with economic value. The dislocation of social and economic value has led to the unintuitive outcomes, like Amazon being one of the most valuable companies on earth, while assigning almost no value to the Amazon rainforests, which acts as Earth's lungs. The excessive reliance on markets to drive outcomes is also evidenced in daily life, with parents who are levied a fine for late pickup for children, often interpreting that fine as a fee for a late service, as described in Levitt and Dunbar's bestseller, Freakonomics. What is clear is that we cannot solely rely on the wisdom of markets to ensure a transition to a low carbon economy and sustainable future. This point has been made forcefully and articulately by climate activists such as our own Yola Mogongwana and Europe's Greta Thunberg. One cannot be moved by the assertion of these young activists, whose sense of urgency with which we must act is patently clear. However, what is of practical importance is that a transition be made through continued economic growth and economic benefits for the society. In South Africa, we call this a just transition. The aim should be to close the gap between social and financial returns, what we generally call sustainable growth. To do this, we will need markets, but we will also need social values, morals, ethics to inform those markets. To do this, we will also need to reorientate financial resources. We must do this as a matter of urgency, and indeed, those of us who are most likely to live with the consequence of inaction, the young, are already acting in a way that's compelling many companies to act in a sustainable way. As mentioned earlier, the transition to net zero can provide significant benefits. The shift will require huge capital investment. It will be job heavy and it will require innovation. To capture the benefits and manage the risks, we need to do two fundamental things that are at the heart of what the JSE does. First, reporting and disclosure. What gets measured gets managed. Climate change represents a unique challenge for reporting and is unlike other risks in that it cannot rely on the experiences of the past. They are also likely to be non-diversifiable, highly correlated, and subject to tipping points, meaning things could get really bad at the same time in many places. The gold standard for disclosure was created by the Task Force for Climate-Related Financial Disclosure, a consistent, comparable, and comprehensive description of the carbon intensity activities of firms and investments that they undertake is a fundamental building block to the transition to a low carbon or net zero future. The G20 has recognized the importance of the TCFD framework, with many countries moving towards mandatory reporting, including peer jurisdictions like Brazil and jurisdictions like the UK. This work needs to be supported. This work needs to be supported and is being supported by a common reporting framework. Specifically, the IFRS Foundation is looking to establish an International Sustainability Standards Board, ISSB, to develop this global standard. The G7 and G20 countries have welcomed the IFRS work program. The IFRS effort will build on the recommendation of the TCFD, which have gained worldwide acceptance. The second is taxonomies. The requirement is to mobilize financial resources to transition the economy to a net zero future. To unlock sustainable finance, we need common definitions or taxonomies for the activities that contribute to our climate goals. The general need to these taxonomies means that we are unlikely to have a single global taxonomy, although this would certainly be the most efficient outcome. But as more jurisdictions develop their own taxonomy, we must ensure that they are compatible and interoperable. Otherwise, cross-border green finance flows will be severely constrained. This is a particularly important issue for capital importing economies like South Africa. In particular, there is an opportunity to develop clear definitions of what activities should be considered transition activities. This is especially important for us as well. This will support economies which are at different stages of the journey towards net zero, especially our peers on the continent. So policy in South Africa is already moving in recognition of the need to mobilize finance and to address the risks to a transition to net zero. In the National Treasury technical paper, which Leila alluded to at the top of the conference this morning, we have undertaken to do 5 things. One is to define sustainable finance for all parts of the South African financial sector, including banks, retirement funds, insurance companies, asset managers, and capital markets more broadly. 2 is to take stock of the global and national financial sector policy, regulatory, and industry actions taken to date in dealing with environmental and social risks. 3 is to identify market barriers to sustainable finance and the implementation of environmental and social risk management best practices. 4 is to identify gaps in the existing regulatory framework and recommend actions required of regulators, financial institutions, and industry associations. To address these questions and working with the industry and social partner, National Treasury has established 5 working groups, including the two that relate to the key challenges of reporting and taxonomies. This work is being coordinated by the Climate Risk Forum, comprising of a broad group of public, private, and social society stakeholders and chaired by National Treasury. Of particular relevance to this audience is that in the coming weeks, the taxonomy and disclosure working groups hope to publish first drafts of the work that they've been undertaking in these working groups. Firstly, The taxonomy paper, which is an initial step focusing on green investments, the green finance taxonomy, will set out classification systems or catalog system to define a minimum set of assets, projects, activities, and sectors that are eligible to be defined as green in line with international best practices and national priorities. It could be used by investors, issuers, and other financial sector participants to track, monitor, and demonstrate the credentials in green activities in a more confident and efficient way. In future, the working group will work to develop more granular criteria, including metrics and thresholds, to help operationalize the classification system. We hope to broaden and embed the use of the taxonomy in line with what is happening in other jurisdictions where mandating of its use is already occurring. Secondly, the disclosure draft paper will also be published, and as I mentioned earlier, broadly be focused on TCFD framework. Let me stop there and end up just by saying that we wish all the COP26 negotiators all the best of luck in the work this month, and we hope that the urgency that is certainly required is reflected in the outcomes. Our work in the financial sector will be then to mobilize the resources necessary and to reflect the values and the societal goals to ensure a sustainable future. Thank you. Let me stop there.
Thank you very much, Vukile. I particularly enjoyed the beginning of your speech where you mentioned the reference to economic theory, and some of the key messages I got from you is that it's value-driven, essentially, and us as a society determines those values within which economic actors, and particularly in the financial sector, must operate. So it feels as if we're in control, although sometimes with climate it feels as if we're not. And it's very interesting as well to hear about the work that the National Treasury is doing from a policy perspective in supporting this sector to address some of these critical issues. So thank you for that, and look forward to seeing the publication of the disclosure guidelines and of course the taxonomy, which I think will provide significant guidance to the market. So thank you. So we're now moving on to our next keynote speaker, who is from the JSE. So Shamila Subramani is the Chief Sustainability Officer of the JSE. And I won't read through her entire bio because it is available on the when you register for the event. But suffice to say that she is responsible for advising the Executive Committee and the Board of the JSE on sustainability and integration of sustainability into its overall strategy. And as mentioned by Vukile and also by Leila in the talks, the JSE plays a critical role in many areas related, particularly in relation to issues such as disclosure, but also product and instrument, sustainable finance instrument development in the country. So very important to hear what views they have around transition finance. So thanks, over to you, Shamila.
Thank you very much, Malango. Just to give me a second to share my screen. I just realized this morning it was a little bit helpful to take people through a bit of visuals on this. But thank you very much for the warm introduction, and it's great to be here today with everybody. Vukile has given us a great overview of some of the work that's being done under the different working groups within the National Treasury process, looking at that financing a sustainable future paper. So I'm going to share with you today a little bit about what we've done in the Sustainable Finance Handbook. So that is a committee that I chair, or the working group that I chair. We have deputy chairs being the Banking Association and the Associations for Savings and Investment in South Africa, which is ASISA. So the handbook piece brought together a number of different players within the financial sector. And what we really wanted to do was to come up with a view and something useful in relation to sustainable finance and helping to increase education in this area. But the actual aim of the working group itself was to say, well, how do we map the instruments that are already out there? How do we then consider what is happening globally in sustainable finance with a view to saying, well, there's this entire aspect of sustainable finance, and then we want to bring that to a local context. So there would be particular instruments that could be even more relevant in a context like ours. So let's map this global space. Let's use a lens to bring this to become more relevant for the country, and what instruments could be leveraged better than perhaps other jurisdictions might be, and what can we learn from others. So the first piece of our work in doing that is this handbook. The next piece of the work that we're going to be doing as the Sustainable Finance Working Group is going to be to look at then mapping all of this again and saying, well, how do we work together with the different actors in the ecosystem to map out a path for sustainable finance for the country as well? So lots of work still ahead. This product is the first of this working group, and the handbook itself is actually now a tangible asset that can be used by anybody. So let me quickly take us through a little bit about what sustainable finance is. So if we look at it, I want to draw your attention just to the bottom of the slide. We're talking about this for many on the line. It might be a new concept or still need a little bit of clarity. So it's about delivering sustainable finance as a theory of change, which is linking financial sector operations to their contribution to the sustainable development goals and obviously sustainable development. So if we look at that, it's achieved when the financial sector, using ideally science-based methodologies and best practice norms, does these things that we're looking at on the slides in front of you. So we want to maximize opportunities to mitigate risks that are brought about by social environmental issues and achieve the benefits in each of those social, environmental, and economic aspects. So up to now, by and large, our view has really been quite one-dimensional, focusing mostly on economic and financial, and the deficit has been on considering economic and environmental and social aspects. And I won't go into that because Vakila's sketched that out so eloquently already. And then what we want to do is to take these results that we have on maximizing that, looking at our opportunities, looking at our risks, and to link those to products and activities and capital allocations, and ultimately do that to contribute to the delivery of sustainable development goals. So how do we move the money to be able to achieve sustainable development? And that's probably the simplest definition of sustainable finance. So what is this handbook that we've developed? It is a knowledge resource, and you will see that it has a number, it can apply to a number of different people. It explains the practices and the methods that the financial sector and capital markets should use to drive sustainable finance, and links those to the assets and the projects that need to be developed to transition to this inclusive and prosperous South Africa that we all want to build. And in terms of the governance on this, it can be updated as the sustainable landscape globally and locally evolves. So this is definitely a piece that we expect to be dynamic, but the first part of this is available. And if you look on here, there is actually a website called Sustainable Finance Initiative.org.za. And if you look under the working groups, you will find the handbook under the working group for sustainable finance. This website is also a place where you can visit the work of the other working groups under that the forum that Vakila mentioned. So the 5 different working groups that have been convened under the National Treasury process. So who is this book intended for? It can be used by financial sector's actors, those new to sustainable finance who want to learn. This is a space that everybody should become familiar with, at least to some extent. So the handbook can help you regardless of how early you are on your journey. And it's encouraged to progress all this. The idea is that it would like to get everybody up the curve on understanding this because it's such a critical aspect for our country. Financial sector's actors already familiar with ESG or sustainability, but needing to check, to align, to see what progress has happened, to just bring together in one place the plethora of different things that one could look at. Financial sector actors looking for finance development opportunities, improve the understanding between the actors. So regulators will also be able to do this. Others wanting to understand that environment and how they need to create the enabling environment in which we can find and get these instruments to thrive. And then, of course, real economy actors. So the companies that are making this economy work, that are creating employment and wanting to align or access sustainable finance to help meet their aims as they're also trying to transition. So it's going to help with demystifying sustainable finance. It's identifying action plans for different role players, because we've also come up with a set of recommendations that we've actually looked at as an initial pass that says, well, what is the importance of different role players? What can they do differently? What can they do more of or less of or do better? And there's also going to be a tool for communication and enablement between regulators, between real economy actors, and a vast diversity of stakeholders where more conversations need to happen as we move into the next phase of the work, which is to try and create that roadmap to help us as a country. So there's a number of areas. I think we sort of covered this. How do you better understand those methods and instruments and the like? What is current there? What is emerging? What projects and assets are most likely to be mapped to which frameworks? Those are the kinds of questions that you're probably plagued with if you're just new to the space and try and figure out what's going for what. This could help you to do that. So it was developed, like we said, to help with that. It's answering those questions. It's helping with the creation of the knowledge and helps others understand those objectives as well. But I think more importantly, it will make it a lot easier to take up this call to action and get our country moving very fast on the reallocation of capital practically to where it needs to go in order to be able to finance the sustainable economy. So what can you find in this handbook? A series of annexures in there that are on the right-hand side, including one that's very topical today on sustainable finance and the just transition. But really, number one is what is sustainable finance? Number two is the mapping of the methods. And then you've got a mapping of the instruments. So there are obviously instruments like green bonds, like green equities. What are those? So the first one will tell you the different methods, the frameworks, the standards, the norms that you're finding in this place, and then how you're mapping instruments to those. And then lastly, the mapping of the enabling environment, which is a part of a conversation, but also making very clear who fits in where in this context of sustainable finance. Some great resources that you can find in the handbook, an introduction to the financial system and what it looks like in South Africa, key learnings and international examples, which are always very helpful. What are the norms? What are the standards? When somebody says to you TCFD and somebody says to you ICMA and somebody says to you, IFRS, where does this all fit in? You will be able to find some of those answers within the book. What is the just transition? What are the challenges in relation to that? What are the changes that we need in the real economy to achieve sustainable development? So you can see where it comes together for most actors in our broader ecosystem as a country. So there's also a series of maps and information on sustainable finance instruments and their application. So which jurisdictions are we seeing these actually working in? How are these working? Who can it apply to where? So some very useful tables and graphs that kind of make sense of a landscape that sometimes is quite difficult to make sense of. And how do these relate then to green economic activity? So where does it fit in? What is the spectrum of green? And how can we look at that? And green economy end-use sectors mapping. So saying, okay, if you're in the energy sector, or if you're in the chemical sector, or in retail, where does this fit in for you? What kind of instruments should you be looking at? What norms and standards might be more applicable or less applicable to you? And then, definitely an analysis and introduction to major frameworks and principles and, the alphabet soup that we often see in this space. So I hope that whets your appetite and that makes it a little bit easier for you to understand what you can look forward to. Just excuse me, I'm going to stop sharing the screen. And that would be something that is valuable to all actors. And I'm hoping to hear from you. So on that note, to say thank you very much for having me today. And just a quick note on behalf of the JSE to say that we really hope that you enjoy the session. You take every opportunity to engage with this. I certainly am willing to take any questions if they are on the handbook. And later on, just please feel to pop them in the chat and we'll make sure that we attend to those as soon as we can. Thank you.
Thanks very much, Shamila. The handbook sounds like a really fantastic resource, especially just simply in terms of defining sustainable finance. There are many definitions out there, so it's very useful to see a definition of sustainable finance and options in terms of instruments and methods that can be applied to address sustainable finance. And finally, of course, the enabling environment, which we've already heard from Bukile, the National Treasury is working on, but that's also a critical part to deliver sustainable finance. So thank you for that overview, Shamila. As she mentioned, if you have any questions either for Shamila, please put them into the chat as well. And if Bukile is still on the call as well, I think there could be some questions directed to him as well. So moving on to the next section, we're moving in now into our discussion segment. And it's a moderated discussion by Deo Onyango, who, similar to me, is a colleague at the IFC. And in terms of Deo's background, he's a structured finance and climate business industry specialist, covering the whole of sub-Saharan Africa with IFC. So he essentially supports financial institution clients with developing viable climate finance solutions, such as transition finance, which is the topic of discussion today. And so Deo, I'm going to hand over to you for the segment looking at how to create a sustainable economy and the role of just transition finance in South Africa. Thanks.
Thank you very much, Malango, and welcome everybody to the second day of the JSE Sustainability Showcase. As you already heard from the opening speech, Kile's opening speech, the transition is already here, and its justice is linked to how inclusive it is in the context of South Africa. Now, in President His Excellency President Ramaphosa's opening speech at the Climate Action Summit, he did set out just how broad the concept of just transition in South Africa is. He said that as part of ensuring a just transition, we will need to put in place measures that plan for workforce reskilling and job absorption, social protection and livelihood creation, incentivizing new green sectors, diversifying coal-dependent regional economies, and developing labor and social plans as and when aging coal-fired plants are decommissioned. This really set out the broad context of the just transition in South Africa. And this is, if you look at the different sectors, it's energy is a key factor in it, waste, food, technology, livelihood, skills, biodiversity, and water are the key sectors that have been identified as being part of this transition process. Now, it's widely accepted that finance is a key glue through this. And as you've heard, Shamila and the JSE have put in place a number of tools that will really look at linking financial sector operations to their contributions across all of these different sectors. Today, during this session, I am honored to have a distinguished panel of experts who will share with us their thoughts, their experiences across all of these different sectors. Now, to kick it off, we'll kick it off with Mandy Rambarus, the General Manager, Just Energy Transition with Eskom. That's Mandy, who will look at the future of South Africa's electricity sector and a just transition to true zero. We'll follow this up with Repurposing Komati, who's a program manager, climate and energy at the National Business Initiative, who will share with us empirical findings on just transition sector pathways across in South Africa, and really kind of beyond just energy, which is key for building the resilience throughout the ecosystem. We'll look at the rest of the different sectors with Repurposing. Following this, Vicky Sins, who's lead climate energy and from the World Benchmarking Alliance, will give us a broader global perspective on how capital markets can support and promote a just transition. And then we'll round it off with Nigel Beck, Head of Sustainable Finance at Rand Merchant Bank, who will then bring it all together by looking at the role of financial institutions in driving innovation and adoption of new standards to increase credibility, and really kind of round off the discussion around the role of just transition finance in this discussion. So thank you very much, everybody. And to kick it off, I'd like to ask Mandy to start us off. Thank you.
Thank you very much, Deo. And I'm just going to attempt to share my screen. 1 second. And I think we've had really, really good background information, from the previous speakers, and very excited also about the handbook that has just been mentioned. So I'm just going to try and get these slides up quickly, and then we can kick off. 1 second. Not sure why it's not. All right, maybe we're getting there. Please, can you let me know if you can see that, Dale?
Yes, it's just come on. Yeah, and yeah, Thank you very much.
Perfect. So I just got a few slides that I'm going to run through really quickly. You know, we've had some really good background information, like I said, on what sustainable finance is all about. And I think Shamila spoke very eloquently around what is actually needed in defining a sustainable development and how do we get there. So I just want to bring it a little into the energy sector in terms of what we're planning on doing as Eskom and how we see this transition finance and how transition finance is going to assist us. And you know, from an Eskom perspective, obviously, when we transition, it has an impact on the economy of the country. So we talk about Eskom's just energy transition within a South African transition. And just to put that into perspective, if you look at the emissions, so these are greenhouse gas emissions in the country, from electricity production perspective, we are 41% of the emissions in the country. And so the value proposition is that if you decarbonize the electricity sector, which is the quickest and the cheapest to decarbonize world over, we've seen the examples around the world, you actually then have a positive impact in terms of the rest of the sectors that we can decarbonize quickly. So it has, you know, you can decarbonize then the rest of these sectors quite easily. And this is a slide from the work that Rachel Metzi and the NBI team have done. So I'm sure she's probably going to talk to the same thing. So I won't talk too much about that. So in terms of what it is that we are putting in on the table from a just transition perspective, Eskom has publicly announced a 2050 net zero by 2050 goal. And so that's a very long time away to reach net zero emissions. And so what we've done is we've taken that long-term goal and broken it up into a shorter term edible chunks of a strategy, as I'd like to say. And so this is our ambition for the next 5 years. What is it that we want to push in the next 5 years? So just quickly from a just perspective, you know, we're doing a number of studies at our power stations that are shutting down to understand what would the impact be of shutting down those plants. And then once we have those results, we've got results from 3 of the stations already. It's the so what? So what do you do with these results? And then it's about how to create jobs. What is the local manufacturing industrialization potential, and working together with others from a cooperation agreement perspective to understand what that is. From an energy perspective, we're looking at repurposing our power stations. We were at Komati Power Station yesterday, which is our flagship in terms of repowering and repurposing. I've got a slide a little later on that just shows what is happening there. Very exciting in terms of repurposing that plant. We're also looking at accelerating renewables plants. We have greenfield sites where we can put renewables on the ground. We just need the financing, which is what we're here to talk about. We're also looking at battery storage. We've just completed some engineering studies at 4 of our sites that we are shutting down: Komati, Henry, Grootfontein, and Camden. And the engineering studies have come back to tell us what types of technologies we can put in, what capacities we can put in, how much are they going to cost us, the potential environmental impacts, the social impacts, so that we can put out the full idea to the market in terms of this is what our repowering and repurposing would look like. Same for storage. We're also looking at the possibility of gas, and I think all of our colleagues that are in the financing field will tell you that not many people are wanting to fund gas, so that is something we would have to talk about, given that gas is a fossil fuel. We also have a very exciting microgrid opportunity, which is basically a grid in a container that we're looking to roll out, especially in those parts of the country that are not yet electrified. Small-scale embedded generation, the lifting of the 100 megawatt license limit and making sure that our distribution grid is prepared for that. And then grid upgrades. You know, we need infrastructure development from a transmission and distribution perspective, regardless of whether Eskom does the investment or whoever else does the investment. The country needs these infrastructure development. Then from a transition perspective, and that is basically what we're talking about today, is around the transition financing. We've had a number of engagements, as you would have seen in the media, with a number of DFIs, with a number of multilateral banks around transition financing and defining that from an energy perspective. There's a lot of interest in the market, a lot of keenness to fund a transition in a developing country such as ours. But of course, the nitty-gritty comes down to what is just transition financing. Do we have financing not just for the energy part of it, for the technology, but also for the just elements? And I think the handbook, in terms of how do you define sustainable finance for a just transition, is extremely important in touching on all of those elements. From an enabling perspective, like I say, we can't do this on our own. So a number of cooperation agreements with other businesses, with government. We have a cooperation agreement with the DTIC, for example, on expanding on local manufacturing, industrialization, policy alignment, making sure we aligned with government in terms of policies and in terms of our governance framework that Eskom is governed by. And then we're running quite a big change management program within the company. So what is it that we've put out as a just transition financing facility as Eskom? We've put on the table with these multi-lender financiers that we've been talking to say that what we would like to table is a multi-tranche, multi-year facility that is funded by this multi-lender syndicate. So the simplest analogy I can think about is if you think of a building loan, when you take out a loan to build a house, it's a similar sort of facility, except here we're looking at multi-funders. So the governments that you see at the bottom of the slide. And what we are saying is that if you put money into this facility, which will be managed by the lender group, so not managed by Eskom, not managed by the South African government, what the facility will do is provide concessional financing to projects on a pay-for-performance basis. So that is a safeguard in the facility to say, we do require this financing, this transition financing, to transition us from coal to renewables. But, it comes at a huge price tag for us as a country, given our dependence on fossil fuels in the past and the number of communities and the number of towns that have been built around our power stations and around our mines. So pay for performance, meaning like your building loan, you release tranches of funding as you reach foundation height, as you reach window height, or as you reach ceiling height. It's a similar sort of concept, but also based on a decarbonization goal. So we commit to decarbonizing the grid by X amount, by X date. We commit to shutting down X amount of megawatts of coal and building X amount of megawatts of renewables. And so that is the pay for performance, and then the progress payments I've already spoken of. So those are two safeguards that we've built into this facility. We shared this with a number of financiers, the US, the UK, France, and Germany, plus multilateral banks like the World Bank, like the African Development Bank. And, they've come back to say that, which is quite complimentary, that even though it's a straw man, it's just an idea that we've placed on the table. We've done a little bit more work on fleshing out the straw man. And what we've heard is that, it's been helpful in focusing minds on exactly what we mean by transition finance in South Africa in the energy sector. And it is the most developed plans they've seen worldwide. So I think that's very encouraging. Of course, it's novel. It's on the table for discussion. There's a lot of negotiations around the nitty-gritty that still needs to happen, but very positive signals that we're getting so far. So what will this facility buy us? So in the initial stages, and like I say, all of these things, there's caveats around all of these numbers. In the initial stages, for the financiers to understand what we mean, we've put down a bunch of projects that we've done some work behind getting the numbers in terms of the megawatts, what it would cost us. These are billions, so it's going to be a chunk of money. And then from a distribution perspective and from a transmission perspective, we've also put down what that actually means from projects on the ground. So when funders say to us, there's lots of money available for financing, but countries like ourselves usually do not have projects that are ready to go. It really is a serious issue. So we've made sure we've done some development work behind some of these projects, and they're ready to go. When we talk about shovel-ready projects, it means that if we got the financing tomorrow, we could start implementing these projects. We've just done engineering studies, like I said, on Komati specifically to confirm these numbers around the megawatts and around what is needed. And like I say, distribution and transmission grid strengthening is absolutely crucial. We have to do grid strengthening in the Northern and Eastern Cape. It's a key enabler for rollout of renewables of capacity in this area, not just from an Eskom perspective, but the IRP, private sector engagement and enablement, is extremely important. So the reality is that we do need this financing. If you add up all of this money, it's about 400 billion rand. The financing is crucial for us to get us to transition from where we are now to a lower carbon future. So just quickly, my last slide is what will Komati look like. So Komati, if you haven't been there, in Malahleni, is a power station that we will be shutting down finally next year. It's got 1 unit out of 9 running, and that unit will be shut down exactly a year from now. But we're not going to just, lock the doors and throw away the keys and say that's it. we've actually started repurposing Komati. So like I said, we were there yesterday also to look. So the site has progressed a lot more from the pictures you see here. What we started doing is a small agrivoltaics plant. So if you look at these gantries, they're much higher. We've got solar panels on the top and agricultural activities underneath. So very interesting agriculture that we saw there yesterday on crops that can be planted underneath your plant. So this is a small pilot, 500 kilowatts, but it's demonstrating that it is possible to repower. So while we have the coal units running, we can do these things in parallel. And then we also have moved our containerized microgrid from our research facility, which is what you see in the picture here, to Komati Power Station. So this is that same container here at Komati. Inside the container are these battery packs and controllers. On the outside are these solar panels, like you can see, with awnings. And what we're looking to do, you can put these panels into the container and transport it. We transported this from Germiston to Komati in Emalahleni and had it set up in a day. So what the plan is to use our warehouses at Komati Power Station to create an assembly line to manufacture and assemble these microgrids for sale. You know, it costs about 1.5 million rands for one of these that can power up to 25 homes, depending on usage, of course. And so when we look at combining this with areas that need electrification, it is absolutely an amazing solution. Lots of interest from funders for grant funding to actually get this funded. Also, on those assembly lines, we can actually use local labor in Emalahleni. So the idea is to get these containers, get firm orders for them, get them rolled out, and we can use local labor to get them going. So I will stop there, Deo. That was my last slide, but just to give some practical examples of what we mean by transition finance and the financing we actually need now to get this decarbonization path going. Thank you.
Very, very, very exciting, Mandy. Very, very exciting. And for everyone, just a quick recap, the JET strategy that Eskom has put in place, just doing better for people and planet, energy, clean and sustainable, transition really by transforming the business models so that they can attract more green finance, and really being cognizant with enablers that collaboration has to happen across different constituencies. Really, really great insights onto that. I think with regards to finance, multi-tranche, multi-year facility, multi-lender facility with safeguards through the pay for performance. That's really important, naturally, if you think about from a finance. But not only doing that, also going to find shovel-ready projects with clear focus areas around grid strengthening, a number, 400 billion rand, and I would imagine that's just the tip of the iceberg because there's more that will be needed, and then rounding it off with an amazing showcase of what's already happening, a real action at the Komati plant. So thank you very much, Mandy. That was very, very insightful, and I think for everyone, including myself, very exciting to see what's happening with the transformation. Next, I'd like to ask Ritumitse Molotsane to share with us empirical findings on just transition sector pathways in South Africa. And as Mandy also mentioned, believe that there will be a clear link to what Mandy shared. Thank you very much. Ritumitse, we can see the slide, but maybe you unmute yourself.
Thanks, Dave. I thought by this stage I would have cracked it, so my apologies for that. As I was noting, it's a great pleasure to be here and really hearing some very exciting initiatives that are underway. So I'm very happy to contribute to this conversation. I'd just like to share a little bit of what we've been doing at the NBI. This is work that's been implemented in conjunction with the Boston Consulting Group as well as BUSA. And it's really about breaking down what a just transition means for the South African economy. And we focused on those key sectors where we expect the most mitigation to be coming from. And really the premise behind this work is an understanding that South Africa does need to decarbonize. Most of our trade partners have already done so. And as a signatory to the Paris Agreement, this is something that we would also like to support. So the framing question around the work that we've been doing is how does South Africa actually decarbonize across these key sectors to achieve a net zero economy by 2050. And that's really what I'll be almost providing a whistle-stop tour of some of the findings that we've uncovered in the work that we've been doing. So just to all let you know, this is a piece of work that we've really made sure that we've brought in as much stakeholder engagement as possible. The intention is to provide a credible fact base that can really inform decision making and help, I think, different sectors and stakeholders to work together in a cohesive manner towards a just transition. It's something that is really complex for South Africa and really does require quite considered planning and collaboration across a number of sectors. So I've just put on the screen there an indication of the level of stakeholder engagement that we've tried to integrate into this project. So both at a technical level, working with industry experts and academia, but also bringing in companies who are expected to lead this work, and also just to highlight really being able to get leadership participation at the highest levels in some of those key businesses that are active in the South African landscape. And those are the businesses that we expect to be driving this decarbonisation pathway that we would like to see by 2050. So in terms of the key findings, I'm not really going to dwell on the energy work, but just to mention that one, we have recently launched the report that details what the decarbonisation pathway looks like in the sector. And I think Mandy has already given you an indication of some of the work that's already taking place towards this goal. But perhaps just to highlight a few things. The first being that South Africa really does have extensive renewable energy resources. And from the work that we've done, it's evident that a renewables dominated system will be the most competitive system for South Africa. And there's huge economic opportunity in this space. So we are anticipating that in terms of deploying renewables, we really need to reach levels that are almost 4 times the capacity of South Africa's coal power plants today. So that's an enormous investment, estimated at about 3 trillion rands over the next 30 years. So this is an area that is obviously really key in transforming our economy, and one that has considerable social implications as well. So I'm very glad to see that Mandy did touch on the work that Eskom is doing to address some of the concerns around job creation, as well as the broader social and economic impacts. From the petrochemicals sector, so what we've identified, obviously, with 3 decarbonisation pathways. And what you see there are the 3 different options, as well as the mitigation impact that we can anticipate from each of these different options. For now, I'll just highlight more around the new green assets, because that is the pathway that we see that leads us to net zero by 2050, and also provides considerable economic opportunities in terms of repositioning some of our industries today. So really just to highlight some of those key decision points, because what the studies is expected to do is to inform decision making. And I would highlight that particularly around some of the green hydrogen options that we're seeing. So that's your new green industries. The levelized cost of green hydrogen is really what is expected to drive the affordability and competitiveness of this lower carbon fuels and chemicals sector. And so we anticipate a lot of action and a lot of developments around this area, because it's something that South Africa has focused on, just looking at the hydrogen economy over the past few decades as well. So we are anticipating that there will be quite a lot of focus in this area. We've also highlighted some of these other signposts that we need to keep in mind, things like an understanding of the policy and incentives that are required in order to support this transition, just noting the level of investment that's required, and the dynamics around making sure that access to these fuels is actually affordable and has a positive impact on those downstream industries that rely on the energy. From a mining perspective, just to highlight 2 things. One is that there is already quite a significant amount of pressure on the mining sector to decarbonise. And so that's really about how mining operations are actually implemented. But there's a second interesting dynamic as well, and this is more related to your transition risk. So this is really the change in the value pools and commodity markets, and the increase in demand for different commodities as well as those that are decreasing and that have been the pillar of the South African economy for a number of years. So these are the two key areas that I'd like to highlight. But in addition to that, there is a need to decarbonize, but because of the nature of the mining sector in particular, there's a very important pressing need to be able to adapt to climate change as well. So in terms of those shifting commodity pools and the value pools I was indicating before, this is just a graphic that's highlighting where the positive growth potential lies relative to those commodities which have traditionally played a key part in our economy. And we're seeing that changing, and really decisions around how we manage those changes are really key. So what I was saying from an operational perspective, I indicated that mining operations need to be decarbonized. And the previous slide that was shown there was just indicating where this opportunity lies. So a considerable amount of decarbonization can occur within the mining sector, and this is more around power generation as one would expect. But there's also some opportunities that are sitting in being able to switch fuels from a transport perspective, and also to look at the electrification of stationary and machinery, as well as some of the processes that take place at a mining level. Looking at the folio sector, so just some of those top line indicators that we're seeing, what is clear is that South Africa is warming and drying, and you see that there's an increasingly kind of spread of this red area that really has significant impacts for agriculture. So what we understand is that there's some really high risk subsectors within the agricultural space. So cattle farming is one that we've seen that is at quite high risk, as well as deciduous fruits. And there are a number of other key crops that we rely on from an export perspective, but also from our own food security needs. So the need to adapt to climate change here becomes increasingly important, just noting the increasing amount of drying and warmer temperatures that we can anticipate that impact on the sector. So just in conclusion, and just noting the time, just to highlight some of those key conclusions that we found. The one, I won't dwell on the power system. We do know that renewables do present a huge opportunity. From a transport perspective, we're still completing this work, but what is clear already is that electric vehicles are really set to dominate. And even in the most conservative of the modeling scenarios, we still expect electric vehicles to play a huge role in reducing emissions from the sector. Just in terms of the mining and the petrochemical sector, I've highlighted the opportunity that exists really to convert to green chemicals and fuel facilities, because there is a considerable amount of pressure on conventional refineries, and we see that as early as 2030. We've also highlighted kind of the shifting commodity pools, but that there are opportunities that have been explored, particularly around hydrogen and fuel cell technologies that could be linked to the mining sector and possibly provide some opportunities there. And perhaps just finally on the agricultural side, I've mentioned really there is a greater need to focus on climate adaptation, because we see the risk of those key subsectors within agriculture. And one of the things that we've noted is the impact that we could see on sustainable diets and food prices going forward. So these are really key considerations that we need to be building into our future scenarios. What I like to just highlight here is that even though initially this work was focusing more on the mitigation pathways as a basis for really being able to provide a business case for great investment in this area and really directing resources to mitigate climate change and to ensure that we do this in a way that is inclusive. Adaptation is also a key part in some of those sectors. And in this particular case, I've just highlighted the mining sector as well as agriculture and forestry. And just to leave it here, I just wanted to highlight that although we've done quite a considerable amount of more techno-economic modeling, all of that work is really couched within this framework of understanding what will contribute and help us to create a just transition. And it's all about these elements around job creation, making sure we address some of the social concerns and dislocation complexities that might arise. Education and capacitation are obviously key, but we have these other challenges as a country that we are working on around economic inclusion, ownership, as well as quality of work. So I'm going to stop there, just noting that there are others as well who will be presenting. And just to also mention that more information is available at the NBI website, and I'm happy to share the link. Thank you very much, Dave.
Thank you very much, Rutumetse. That's again a really insightful presentation as we go along. I think the quick wrap up. I would say very critical to start with the framing question: how does South Africa decarbonize? And the focus on being able to provide very credible, fact-based reports and grounding that. So thank you very much for that. Just a quick highlight, on with regards to the power sector report, as you heard, that's already available, so that we will kind of give a perspective of decarbonization. Critical the thing that I noticed was the fact that you recognize that South Africa does have extensive renewable energy resources, and you even put a number to it, which is to be able to support the whole sector and to decarbonize. Renewable energy power or generation has to be 4 times the current coal capacity. And even more critical, you put a number to it. So that's 3 trillion rand. So we've gone from 400 billion rand, now we're at 3 trillion rand, and still kind of picking up, right? As we say, the tip of the iceberg and still moving forward. But really good work as well on the petrochemical industry that will provide quite a bit of support when we think about green hydrogen, as well as sustainable sources of carbon. So this is very critical. On the mining sector, a key part of the South African economy, looking at also the shifting value pools and how that has an impact within the economy. And that will be a lesson for also the other sectors as further work is done on transportation, on agriculture, forestry, and other sort of land use as well, looking at whether it's cattle or poultry, the different sectors which are part of the economy. So we're looking forward to more reports, and I would guess also more numbers that will show that finance still remains a critical path around this. No pressure, Nigel, but as you can see, the numbers are ticking up. Good. So just to move on, I would now like to ask Vicky Scenes, who's lead climate, to share with us a bit more of a global perspective. And as we talked about, bringing in some global best practices and benchmarks, Vicky, we'll pass on to you. Thank you.
Thank you, Deo, and thank you all for being here. And I would like to ask Veronica to share the slides, please. As Deo mentioned, I'm here to provide a bit of more of a global perspective. To indicate, as I heard previous speakers as well, there's a need for more data and more information around what actually is a just zero transition, but also how can finance support that transition. So I will share some ideas that we have from a World Benchmarking Alliance perspective. So first of all, next slide, please. Where I will tell you a little bit more about who we are, because not sure that everyone on this webinar knows about the World Benchmarking Alliance, but we are a global non-for-profit, and we are here to mobilize the private sector's contribution to reaching the Sustainable Development Goals. And we do so by, we're looking at 7 system transformations that we believe need to happen in order for the private sector to be able to contribute to that transition. You can see the 7 system transformations here on the right. I won't go into the details of all, but just want to highlight when we talk about the just transition, we look at the decarbonization and energy, as you can see in the yellow slice, and we look at the intersection with the social transformation that sits at the heart of this wheel. So we do this collectively. We have a global alliance of over, here it still says 220, but we're growing very fast. In the meantime, it's over 260 organizations that support our work. These are organizations from standard setting organizations to business associations, investor networks, as well as civil society organizations, all with the idea to make sure that we have a wide stakeholder group that supports in the end the transition that is needed. We have the ambition to have benchmarked and looked at 2,000 most influential companies across these 7 system transformations by 2023. And everything that we do is available in the public domain. So from methodology development to the assessments to, in the end, the publication of the results, in order to truly drive multi-stakeholder action on further increasing the ambition of the companies in their transformation, as well as really holding them to account if there is a lack of contribution to the transition. Next slide, please. So as I mentioned, keystone companies, we say keystone, that means that we believe that those are the companies that are the agents of change, so to speak. So they are the most influential companies we believe there are around the world. You can see here the geographical spread. We also truly believe it's a global transition, so we need to make sure that it has a significant global representation. And it represents approximately 46 trillion US dollars in revenues, and they are headquartered across 80 countries, of which also a significant presence on the African continent. Next slide, please. So as I mentioned, we look at 2 transformations that come together here. On the one hand, it's the decarbonisation and energy transformation, where we really look at the high emitting sectors and how are they going to decarbonize. We do so by assessing them, using a very forward-looking methodology called ACT, Assessing Low Carbon Transition. And that means that we really look at all aspects of the transition. We first look, of course, do these companies, have they set the relevant net zero or Paris-aligned targets? And then how are they contributing to reaching those targets? And then we look at from an investment and divestment perspective, as well as from a contribution to new business models, CapEx investments in low carbon technology, etc. From that, we make an assessment and we give these companies a ranking and a rating that is publicly available, and then enter into multi-stakeholder actions to really drive the change needed. The just transition assessments that we are currently doing, and I'll go a little bit into depth in a minute, we'll really look at how are these decarbonization plans taking into account the respect for workers and communities and to protect the most vulnerable in this system. Our goal is really to drive the action, like I said, from private sector, supported by investors and policymakers, by really encouraging a low carbon future and contributed by these private sector players. Next slide, please. So, as I said, the social transformation framework that we have presented sits at the heart of the work that we do. This is the first step in assessing a just transition. So here, and I won't go into the details, this is all available to the public online, but it really is divided into 3 main pillars. One is looking at the respect of human rights, which is very much already embedded into international frameworks. How do companies then provide and promote decent work? So we look at health and safety at the workplace, provide a minimum living wage, and how do you empower your workers and achieve diversity? And then, of course, the big part around act ethical, which is the contribution to paying fair taxes. How do you eliminate bribery and corruption, for example? We will assess all 2,000 companies on these main social principles, because that is the basis, we believe, of leaving no one behind in any transformation. On top of that, for the decarbonization that we aim to achieve, we will supplement this with a set of just transition indicators. Can I go to the next slide, please? Which will speak to these 6 areas where we look at how do these companies plan for a just transition for the workers and communities in their supply chains and in their direct operations. How do these companies engage in social dialogue, and how do they really engage with the wider stakeholder community that is impacted by their decarbonization plan? How do these companies create green and decent jobs, retain and upskill their workers in order to, as we heard from previous speaker as well, maintain the employment in the region and in the communities? How do these companies look after social protection, and also how are they advocating for policy and regulation, not only supporting the decarbonization, but really integrate the social thinking around the just transition. So then how do we then look at transition finance? Next slide, please. So just want to indicate what is next. What we are intending to do is we are currently completing an assessment of 180 companies across 3 high-emitting sectors. This is the oil and gas sector, the electric utility sector, as well as the automotive sector. And these results will be published ahead of the COP in next month, so on the 2nd of November. And then we are working to really accelerate the company's contribution on this topic. So we do so by really entering into the dialogue and see that the concept of just transition has always been part of the negotiations of the Paris Agreement, but we've not seen this core and central in the investment world or in the finance world. And that's, of course, we don't see that as very much surprising, but we also believe that that is because in general, it is much harder or more complex to identify measurable metrics as a signal for change. Hence, that's why we are enabling this by launching these results. And then at COP, we will also formally launch a multi-stakeholder collective impact coalition. This is an engagement initiative where we really work with diverse actors over the coming years to ensure that this decarbonization goes hand in hand with social and just an equitable transition. And this collective action is also driven by a lead group of investors to really make sure that we drive for clear disclosure and clear comparable data to drive the transparency that is needed, but also to indicate what is it that is required from the finance community and mainly also from the investor community to engage with these private sector players to support the just zero transition that we need to see happening. I leave it with that. I'm open for any questions and discussions, so please let me know. And if you want to get in touch, then please do so as well, even after this chat. Thank you so much.
Thank you very much, Vicky. And again, very exciting information. And really, I really enjoyed the emphasis on being very credible, being fact-based, which is exactly what Treasury also emphasized in that presentation. And to that, actually, I do have one question, which is when looking at the keystone companies, as you mentioned, this is a number of companies across the world, and also the slide that Treasury then presented, which is the multi-stakeholder support group that is working with the National Business Initiative. Did you see a correlation in the companies as well that are engaging with Treasury and her team?
Honestly, I need to go into more details of what Renewable has presented. But I think there is a general correlation to see that on this specific topic, we see there's still a heavy weight on specific areas, geographical areas around the globe that has engaging on this topic, which is, and I think we need to make sure that we really engage with all regions around the globe, because and also making sure that we really speak to the responsibility of those regions that can decarbonize faster and are capable of dealing with this just transition at this moment in a probably faster way than other regions, and they need to also step up their responsibility to take up that action to go faster in order to then also support regions that probably need more support, both financially as well as in terms of time. So I think that there's definitely a correlation to be found there, but not statistically proven at this stage, but we see that there's a trend emerging on that.
Good, thank you very much. I was looking out for a number because the numbers have been ticking up in terms of how much finance, but I do accept. And one of the critical things that you shared was the social transformation framework, which again I did see a very clear correlation with the building blocks that Treasury mentioned. So this is at the end of it, kind of the core part of it is respect for human rights, providing and promoting decent work, and acting ethically throughout the process. So that really is clearly part and parcel of, on one side, the building blocks, but the targets of what the whole transition is looking to support, and with finance and the call to finance to be able to support this actual engagement. So the indicators will really drive back to what Shamila shared with the action that the JSC is putting in place with regards to how does finance, then financial operations actually contribute to supporting the Sustainable Development Goals. So thank you very much for that. Okay, to round it off, I'd like us now to head to Nigel Beck, who's the head of Sustainable Finance with Rand Metchenbach, to share his perspective. No pressure, Nigel.
Thanks, Dale. I've got a presentation as well, so let me try and quickly share that. I think everybody be pleased to hear that it's just 2 slides. It seems to be flashing on my side. Dale, can you see it? Can you see it at all? It's flashing.
No, it's not coming on.
Let me try again. It worked earlier. There we go. That should be it.
Thank you. Now we can see it. Thank you.
Now we can see it. Perfect. So as I mentioned, so essentially I've got 2 slides, lots of kind of charts and colors to keep us all awake. Very much going to focus on the sustainable finance market, how it's kind of moving towards transition, and then very much look at transition finance. And obviously we can unpack some of that in a bit more detail in kind of the Q&A session. But I think before I start, it's probably useful to just introduce myself. So I think a lot of people have met me before. So I'm the head of sustainable finance and ESG advisory at Rand Merchant Bank. I've been in this field globally for about 20 years. And essentially what my team does is we partner with clients to advise on sustainable finance products and services aligned to their sustainability strategies. So essentially supporting their transition to climate resilience and obviously developing a socially inclusive economy. I've been involved in a number of African firsts in the sustainable finance market, including the first green bond in South Africa and East Africa, the first social bond in South Africa, the first sustainability-linked bonds in Africa, the first green infrastructure bonds in Nigeria, Africa's largest offshore green bond, and the first sustainability-linked loans in Africa. So very much looking at innovation in this space, and I think that really talks to what we're trying to achieve in today's presentation and discussion. I think if we just start off with this first slide, and for logic reasons, I'm starting at the bottom right-hand side, and we're going to work left and around. So we're going to work clockwise from the bottom, and that was very much because I battled to get all these different graphics onto one slide. But if we look at what's kind of driving this market and what are the market drivers, there's essentially 3 main market drivers. The first one is a focus on increased regulations. There's obviously, as mentioned by some of the previous speakers, there's this drive towards standardization. So there's the TCFD, the PRI, there's obviously the introduction of the carbon tax within South Africa, and then more recently, the Green Finance Taxonomy, which has been published by National Treasury and obviously been spoken at in quite a lot of length. So what we're trying to do is we're trying to get to a position where we are able to compare apples with apples, and that's very much coming through in the likes of TCFD. And we're going to see a lot more of this. We're going to see a lot more regulation. We're going to see a lot more standardization in the market. And that's obviously driving behavioral changes in corporates and their supply chains as well. Then secondly, from consumers, we're starting to see a lot of consumers putting their money where their mouth is. They're looking for products that don't have environmental, social issues, that don't have human rights abuses in their supply chain and the like. So essentially, consumers are starting to look at products. They're starting to look at eco-labeling and choosing accordingly. This is very prevalent internationally. It's becoming a lot more common locally as well. And this is very much the direction of travel as we see consumers driving behavior, changing their behavior, and very much aligning with kind of this greener economy. And then finally, but probably most importantly, what we're seeing is a lot of investor pressure. So there's strong investor pressure to include environmental social governance integration in their decision making. Larry Fink, the CEO of BlackRock, has been quite outspoken about that over the last while. And what we are seeing is the aligning of corporates to kind of Paris commitments, and then also an increasing appetite for sustainable finance products, which includes transition finance. So very much, in discussions we've had with corporates, appetite for sustainable finance products, looking at different types of innovation, and then obviously increasingly the need to look at transition finance. If we now look at the top bar chart on the top left-hand side, that's the bar chart around the global sustainable finance debt issuances. And I think the first thing to note is obviously there's been exponential growth. Since 2013 to the year to date, there's a 68% compound annual growth rate over the 8 years. And the year to date in 2020 issuances in the market is $825 billion. But I think what's actually more interesting is if you look at the colors of the bars, is that it's a lot more colorful on the right-hand side than on the left-hand side. So when the market started, there were one or two products. It was very much focused on green loans or green bonds. Whereas in 2020, what we've seen is a lot of innovation in products. We've seen a lot more different types of products that are relevant to the market. So sustainability-linked loans, sustainability-linked bonds, transition instruments, transition bonds, and the like. And very much what that is the market adapting. So the demand for these products and innovation are so it's that supply and demand are essentially starting to align with the supply of innovation and different types of products to meet the demand. The bottom bar chart is the South African market. So if you look at the South African market, it's a much more nascent. It's only been kind of growing over the last couple of years. It's growing at about 183% CAGR over 3 years, obviously coming off a relatively low base. The year-to-date issuances within the market are around 25 billion rand. But what we're also starting to see is similar product innovation, albeit a little bit later than what we've seen internationally. So, for example, if we look at sustainability-linked bonds, we did the first sustainability-linked bond in the market earlier on this year. I think it was in March we did it, whereas internationally, it was done 2 or 3 years ago. And I think we're tracking slightly further behind the rest of the world, but playing catch up quite quickly, and innovation is becoming more and more important. If we look at, where global growth is moving towards, it's obviously moving towards transition, and that's very much the nature of today's discussion. So investors are looking for a direction of travel. They want to ensure that companies are able to demonstrate a transition plan. Essentially, what are they looking at? How they're trying to align to Paris. But obviously within an African context, and some of the other speakers have obviously alluded to this as well, we need to consider the social impacts and the opportunities as part of the just transition. So it's very important that we look at transition, but very important within Africa that we consider the just element of this as well. So if we now shift our kind of focus very much more towards transition finance, I think, transition finance hasn't been around for that long. It's almost something that's come up in the last 6 to 12 months. I think in some instances relatively difficult to find, and people are not 100% exactly sure what it is, but it is growing. And as I guess the market moves and some of these regulations, it will become a little bit clearer. But essentially, it is financing that supports high carbon companies, so essentially brown companies, to implement long-term changes to become greener. So it bridges the gap between traditional financing and sustainable financing by supporting businesses as they journey to net zero. It generally requires a high-level kind of corporate commitment to make sure that the financing that is provided is aligned to transition pathways with an end goal of being net zero or Paris aligned. So there's generally 5 principles that we'll be looking at. Pathways need to be aligned to net zero by 2050 or before. There needs to be essentially a halving of emissions, or very close to a halving of emissions by 2030. So in that instance, what we're looking at is something relatively short, medium, and then long-term goals. It needs to be science-based targets, so it needs to be led by science. Ideally, we don't, want to look at offsets. That gets a little bit confusing, the whole conversation around carbon offsets and the like. But in an ideal world, you don't really want to be looking at offsets. And it needs to look at including current technologies that are immediately available, as well as expected technologies to achieve these specific outcomes. So obviously, if you're looking at a 2050 commitment, all the specific technologies to achieve that might not be immediately available, and they need to be developed. So, the concepts around the green hydrogen, that's going to play an important part of the economy, and hopefully within the South African economy too. But that might not be financially viable at the moment, but that's something that obviously could be developed and moved towards over the next while as we move up towards 2050. And I think then importantly, the commitments made by corporates need to be backed by actions and operating metrics. So they need to be relevant, they need to have actions and operating metrics. They can't be just concepts without something tangible to show what they're trying to do. Now, assuming a corporate is able to look at those various aspects, it allows us to look at transition financing and a number of different instruments at different levels. So we're able to look at an entity level or a corporate level. We could look at performance-linked instruments, which are sustainability-linked loans or sustainability-linked bonds, where what we would do is we would set specific ESG or environmental social governance targets with the corporate. To the extent they're able to achieve those, there might be a pricing benefit that we'd pass on to them. And this is very much where this performance-linked instrument comes from, is that to the extent that you're moving in the right direction, you will be rewarded in better pricing with regards to your debt facility or even your bond as well. Then you're also able to look at activity level financing. So you're able to look at green loans or green bonds at a specific activity. So similarly, green loans, social loans or social bonds. Now, at an activity level, it needs to be at an asset level. So what it means is that there needs to be specific green outcomes. So it needs to be a green asset, renewable energy asset, energy efficiency, green buildings and the like. So there's different tiers of transition financing we're able to look at and we're able to provide. I think with that in mind, we can look at and forecast transition finance, and it's expected to grow considerably over the next few years. It's expected to account for about $1 trillion of the annual funding requirement. So it's going to be a significant part of the makeup of sustainable finance, and it's going to be a significant part of the journey towards reaching these specific climate objectives and aligning with Paris. What we've seen recently, and bearing in mind that transition bonds are relatively new, they've only really been issued since 2017 globally, but there's been about $7.3 billion of transition bonds issued. Certain stock exchanges have now launched transition bond categories, such as the London Stock Exchange, and obviously the JSE is exploring the same that was mentioned earlier. And at the bottom of the slide, you can see there's a number of different international precedents for transition bonds. And if you just unpack one or two, so for example, Cadent, that's a gas network. They raised an 625 million euro bond to replace pipelines to carry hydrogen and other low carbon gases, and also to reduce methane leakage. Etihad Airways, very similarly, also raised an $800 million transition sukuk. And this was to focus on investments in more efficient planes and to eliminate single-use plastics. So what we are starting to see is we're starting to see movement in this sector. It's going to grow exponentially as I guess the financial sector becomes more accustomed to these types of instruments and develop these types of instruments. But I think in conclusion, transition finance is a real and significant opportunity, both globally and locally, and it's obviously something we'd very much like to develop within the South African context.
That was great. Can you? Yeah, good.
Yeah, so that's happy to answer any questions.
No, really great. Thank you very much. And maybe just to give a little bit of a recap for our audiences, you spoke to kind of three main things, which is there's more consumer pressure. And you spoke to Larry Fink, who's been a real, has provided quite a lot of impetus across the world. But alongside that, there's an appetite, right? So the investor interest is definitely increasing. And then there's, regulation and adoption of that, as providing a supporting framework around it. Interesting that within South Africa and across the region, and with your experience, you spoke to the growth of the industry, both on a global level, but in South Africa, which there's, CAGR growth is 183%. Maybe I'll start there with one question. Where do you see the rest of Africa in this growth and interest and provision of these instruments when you think about East, West, North Africa as well?
So I think within the African continent, South Africa is very much, if we look at sub-Saharan Africa, maybe check out Egypt and other North African countries that are doing some of these products and have raised a number of different sustainable finance instruments. But I think within sub-Saharan Africa, South Africa is very much leading. A number of the other African countries at the moment are playing catch up. They're looking at certain sovereign kind of bond issuances that might be social or green. But I think if you take that below and you look at the rest of the corporates within East Africa or West Africa, there's less understanding around the relevance of these types of instruments and actually how to structure them. We do see some activity, obviously, within Nigeria. We've seen a number of different green bonds within Nigeria. But if you look at the rest of the continent, there's quite a lot of work to be done, I think, very much in educating, very much in trying to understand how to structure these and then execute these types of products.
Yeah. And with respect to that, it then gives South Africa is going to be a leading indicator and a leading benchmark for the rest of the region as these instruments develop and the market develops, right?
Yes, that's correct. So what I tend to find is that, I think to the extent that we develop products and regulations and, for example, what's happening with the JSC or the green taxonomy, that's quite often adopted by other African countries as well. So I'm expecting us to lead, and I'm hoping that the rest of the continent starts following and moves in this direction.
Good. And to as we kind of flow into question and answers, and I ask the audience, if you do have any questions, please share them on the chat and we'll bring them in. I'd just like to link to Mandy's presentation, because if you looked at what Mandy shared, one of the ways that Eskom is looking to be able to attract the finance is to create this safeguard around pay for performance. And Nigel, you also talked about performance-linked instruments where there's that element of trial. So do you see these instruments kind of taking a sort of a stepped financing where there's an element of proving some concept and providing finance? Also, as you heard from Eskom, this is a really key pathway to be able to ensure the safeguards for the investments.
So, I think the idea of these kind of performance incentive loans and bonds is definitely going to grow. So, we've seen that internationally. So if you look at that chart that I showed, sustainability-linked loans, sustainability-linked bonds have grown exponentially over the last few years. They obviously have greater relevance to most corporates than specifically, say, for example, if you look at a green loan or a green bond, where you actually have to have green loans or green assets to underpin those type of instruments. I think what's also more important is that, the way financial institutions are looking at this as well as investors. So what they're trying to say is, to the extent that you meet a specific target, then we're willing to give you some type of benefit for doing it. So, it kind of goes to this almost like shared value incentive, like to the extent that you're willing to do something, we're also willing to come to the party. So I think we're going to see a lot more of that. We're going to see a lot more of that within the South African context. And I think, as Mandy can obviously talk to, with what they're trying to do at Eskom, there's potential for us to look at some of those type of instruments, definitely. I think you're on mute, Darren.
Sorry. Mandy, any thoughts to that? Sorry.
No, I think Nigel is 100% correct. It's a relatively new field for us. Well, actually, not just for us, I think globally. So we're looking at the various options, what is available. I think we have a need right now. So from a Eskom perspective, we're looking at what is the simplest to implement right now. And, we're looking at the provisions in the Paris Agreement around transition financing, around climate financing for green projects. But absolutely, as we go along this journey, I think you can stack on other instruments that Nigel's referred to. So there is the potential to do that as we go along and understand the landscape more. But to be honest, our initial view is just to be simple and just to say these are the projects we need to do to transition South Africa in the first phase, and this is how we think it can be financed through transition financing.
Yeah, and one comment you did make, Mandy, during your presentation was that people really don't want to finance gas, right? And at the same time, gas is a critical, pathway to some extent. And this was, as we saw in the latter presentation, that there's an element of affordability in gas providing that transition. So, what could you maybe just deepen that discussion a little bit on how you're looking to potentially mitigate that, and then the rest of the audience of our panelists, please also share your thoughts on the same.
Sure, happy to do so. I think I'd particularly like to hear Vicky's view from a global perspective as well. So we've had a number of discussions with a number of multilateral banks and foreign governments, like I say, and all very keen to get involved with us and finance the transition. But there is a reticence around gas because it is a fossil fuel. And, we feel the same way about gas. It is a fossil fuel, and we don't want to get locked into a long-term commitment to another fossil fuel moving out of coal. But the way we see the transition is as a transition from coal to renewables. And because of grid issues around flexibility of the system, ensuring network operability, because we are shutting down what we call currently baseload plant and moving to more peaky renewables plant, you need something in between that's going to help you to enable that flexibility of the grid and system adequacy. As we say, you need something that can ramp up quickly to support the renewables in case there's a problem with the renewables not being online because of the intermittency. So obviously, battery storage is a great option, but there are thresholds around battery storage. And the other option we're looking at is pump storage. So we are a semi-arid country, so but there might be opportunity for additional pump storage. But if you look at the level of investment we require, like Rachel Metsi said, we need around 60 gigawatts of renewables, or 4 times more, maybe 80 gigawatts of renewables to support the grid that we're shutting down in terms of coal. You do need an enabling fuel. And for now, all our modeling is showing us that enabling fuel is gas. But I do agree that we should not invest in long-term gas infrastructure or not commit ourselves to gas in the long term. The original equipment manufacturers we've spoken to have said that, like Siemens, for example, that we could get hydrogen but in 10 years. So if we want to transition, like we're saying right now, from coal to renewables, we need something that's going to be quicker than 10 years. And for now, that answer is gas. But if there are alternatives, we're more than happy to look at those, bearing in mind the costs and all of those issues. So there, that's where we're looking at it from that perspective.
Yeah. And Vicky, perhaps would you be able to share what you've seen in terms of global benchmarking of that transition in gas?
Yeah, absolutely. And I'm based in Europe, and gas is quite a hot topic at the moment, as probably you've seen. So, but just leaving that discussion aside, I fully agree with Mandy's comments to say that we do recognize that gas is a transition fuel, and it is something that is considered a transition fuel. We have seen that in some regions globally that there have been quite a lot of investments into long-term gas projects at the cost of not investing into renewables. And of course, that is a trend that we would not support in looking for a low carbon future. And I think that's something that we acknowledge when we assess these companies, is that we say, okay, like Mandy said, there is an acknowledgement of that there is a role for gas, but also if you look into the long-term transition, that cannot be the investments that we want to make for the next decades to come. And so there needs to be, it can be supportive of the transition, but it is not the solution of the transition. And that's, I think, the main message that we want to give.
Yeah. No, without a doubt. And that then brings us, from Ruchimetse, from your side, and with regards to kind of the empirical research and findings that you have, are there any other technologies that may not be proven at scale but could provide that sort of safeguard of saying gas could be a transition, but we're kind of working, or there's a development in new technology that could take over that?
Thanks, Deo. I think similar to what Mandy has said, in this particular initiative, we did identify natural gas as a transition fuel. I mean, some of the technologies that are being referred to that could potentially replace this are not yet proven at scale. So I think there still needs to be a lot of work done there to be able to identify and to provide some level of confidence that those are technologies that are viable and that can be integrated into the system. And what we found is that the key determinants in terms of where the lock-in is coming from is obviously around the infrastructure and the technology, and understanding that your infrastructure can be quite long-lived, as well as being able to put in place some of those regulatory frameworks that enable the use of gas. So those are the key areas that one needs to really look at and address as part of this concern around the lock-in. But as to date, in terms of the work that we've done, viable technologies that have come to the fore have not really been identified that can replace gas as a transition fuel.
Yes. And Nigel, so taking that grain, which is there are technologies that may not be proven to scale. You did mention around green hydrogen, and we see investors, to your comment around investors looking for on one side shared commitment, but also a direction of travel. What sort of work or potential instruments can be put in place that invests directly in innovation, in being able to provide the next technology beyond gas and give more confidence around this transition pathway?
So I think, first of all, just if we touch on the gas element, so, I think the multilaterals, for them, obviously gas is not something that they particularly want to potentially finance. I think some of them may finance it. I think commercial banks are probably a little bit more practical, and they understand exactly as Mandy says, there's a need for this transition element. So if you're going to move from coal to renewable energy, you're going to need something to transition, while we develop storage, but specifically if you're looking for peaking power. One thing I think, what we need to consider, to the extent that you're building gas infrastructure, we need to be looking beyond gas and looking at green hydrogen. So if you're going to design it, you could use that infrastructure for green hydrogen in the future. So even though it might not be here, it might not be viable at the moment, there's an opportunity to do that. So, I think, that's the way we've got to start looking at some of these things. If we're talking about transition, we've got to say, okay, it's transition, but where have we got to get to? So, with regards to your question around, what does the future look like? I think what we need to be doing is using our collective intellect across different sectors within research and development. So in other words, pulling different sectors together, different industry players together to create platforms and create workshops where we can come up with the ideas of what the future economy would look like and what future instruments we as financial institutions can develop to support that, but also what industry is looking to develop. So whether that is green hydrogen or something similar or whatever it might be, there's a lot of work that needs to be done on that. And I don't think it's an individual company that can do it on their own. It probably needs some type of collective response where we pull a whole lot of different, as I say, different experts from different fields together. Now, I think that's really what we need. We need that enabling environment to really move towards this net zero type of commitment.
Yeah, understood. Thank you very much for that. Vicky, just going back to the benchmarking that you've done across companies, and just to shift the direction of our discussion a little bit, where do you see South African companies perhaps standing in relation to energy benchmarks and decarbonization and potential implications? Obviously, that brings us back to the discussion around gas, but it would be interesting to get your thoughts from that perspective.
Yeah, thank you. And thank you for the question. I think just to start off with, in general, we looked at 3 sectors so far: electric utilities, oil and gas, and automotive. And the general trend is that we need significantly increased ambition from all 3 sectors globally, right? So just wanted to make sure that we say that out loud first. And from those 3 sectors, we see that the electric utility sector is ahead from, if we compare it to the other sectors. And oil and gas sector significantly remaining behind. So, and I think that's a general trend that we also see back into the companies that we've assessed. I think regionally, if you look at the electric utility sector, for example, you see that Europe is leading the transition, but also has the ability and capability of leading the transition. So we also expect them to do more and go faster in this transition, like I said before, to support other regions to be able to follow their transition plan. We also see that there's, of course, some state-owned companies in South Africa that are also reliant on national ambitions to be increased. And we have, I think, good indication that at COP, we would see, at least also for South Africa, to significantly increase its national ambition. And we truly believe that that is also needed to support, the company's ambitions in that, to translate that back into how these national companies can support the national ambitions of the region. I think overall, we definitely want to see, like I said, an increase in ambition, but also in transparency and disclosure. We expect that there is a bigger need from a wider stakeholder group to support the transition, to also understand where do these companies stand. So we definitely encourage, the disclosure to improve. And when we say disclosure, that goes back to the previous point, also around how are these companies investing into a low carbon technology, which percentage of their capex is invested into supporting low carbon technology, and then also investments into technology that is not mature yet, and how are they supporting then, like Nigel said, so to come together around supporting of technology, because I think that's very important to see for other stakeholders to understand how they engage with these companies to support the transition as well. I think overall there is a great opportunity for the region to show leadership for the rest of the continent as well. If I compare then the look at the African companies that we've looked at, we see that South Africa is doing relatively better than the rest of the African companies we've looked at, but there's still a big step up in ambition and performance that we would like to see happen.
That's great. I actually want to take cue from that and pick one institution, a national organization institution in South Africa. So the Government Employees Pension Fund is a major shareholder across the board with the Johannesburg Stock Exchange, actually even within Eskom. And Nigel, you did talk about ESG being a really key part of, on one side, a shared action, but also driving accountability. So across the board, I would just like to ask your thoughts around how the Government Employees Pension Fund and the JSE as well are really providing that element of driving more accountability. Be interested to hear your thoughts on that. Nigel, perhaps we'll start with you. Yeah.
Yes, so I think, if we look at kind of the JSE and what's happening with the sustainability segment, so obviously, as was mentioned earlier, the JSE developed a sustainability segment, focused very much initially on kind of green bonds. That's now transitioned to looking at social bonds, sustainability linked bonds, and then obviously the idea of looking at transition bonds as well. So I think by doing that, what we're doing is we're starting to see a lot of awareness, first of all, of potential issuers around the opportunity that exists. So, I guess sessions like this, the fact that the specific segment exists, marketing around that segment means that we're starting to see, first of all, investors looking at it more as a specific asset class and trying to say, right, we can identify a specific asset class, it's relevant. And then on the other side, what we're starting to see is specific issuers saying, right, we want to start working in this space. So there's an ability to kind of, I guess, grow the market through some of these type of initiatives that are happening.
Any thoughts, Ruchimetse, and particularly around ESG risks and disclosures?
Yeah, I mean, so it's definitely something that we see as key. So we've done, I think, in addition to the work that we've been doing on the transition pathways, have done work that's looking at the task force for climate-related financial disclosures. So being aware of those risks and making sure that they're integrated into how a company understands its own value. But in addition to that, we've been working with WWF as one of our partners in Just Share in addressing some of the capacity needs that are required for ESG perspective and the understanding of how key it is when making investments. So this is definitely something that is really important and something that at the NBI we have been focusing quite a lot of energy and effort in making sure that the climate understanding and the risk understanding is really core to how businesses do business, and in this case focusing a lot on the financial sector.
Thank you. So there's a couple of questions that we have. We still have about a couple of minutes. So the first one, the question from Luyanda Mbeki. This is to Nigel. It might be challenging to operationalize KPIs as some technologies are yet to be developed. How do you match long-term performance of the underlying project to the instrument repayment terms?
Yes, so generally, if we're looking at a performance-linked loan, we would match the specific KPIs and the specific targets to the life of the loan. So, if it's a 3-year loan, there would be targets that are linked to the life of the 3-year loan. If it's a 5-year loan, we would link targets to the 5-year loan. I think what we're also starting to do is increasingly look at trying to put commitments to explore future technologies, because obviously it's very difficult for us to put in hard and fast technology KPIs or targets around a technology that's yet to be developed. But what we can do is have a commitment for that specific corporate to explore future technologies, to the extent that technology then starts becoming commercially viable and realistic. Then when we look at a further loan, we're able to obviously put in specific targets around trying to roll out that specific technology.
Great. Thank you very much, Nigel. We have a second question from Darren Skogi. So this is asking for comments on the debt for climate change swap proposition from the Deputy Minister. Perhaps we'll start with Mandy. It's directed to Mandy and Nigel.
Sure. So just to say that, I think the way I understand that proposal, it's quite different from what Eskom has proposed, for example, in terms of the facility that I mentioned earlier. Debt for climate swaps can be done. I think they're pretty complex and complicated. I'm not sure of which countries have done them. But, it also has to be worth your while in terms of, if you're swapping debt for climate, what is that climate offering that you're making? What is that decarbonisation goal that you're making? And it has to be quite ambitious in order to do that swap. So it's an idea that's on the table. I guess, I'm assuming all of the financiers are looking at it and exploring it, but it's not something that we would be pursuing.
Thank you, Mandy. Thank you very much. Nigel?
Yes, so I probably similar to Mandy. I mean, the debt for climate swap, it's complex and to some degree it's quite controversial as well. I guess to the extent that it's credible, and can be correctly structured, it's something that we could look at. But to the extent that some corporate or sovereign is just looking to write off their debt on the basis of climate commitments that are not very ambitious, then it's probably not going to fly. So it's something, that's been spoken about. I've not seen a lot of practical or credible opportunities that have been structured in the right way. But I guess in principle, it's something that could be explored.
Good. Thank you very much. So just as we kind of wrap up the session, we have 3 minutes left. Perhaps, ahead of the break, I'd just like to ask our esteemed speakers if you could all maybe give just one final thought that would wrap up the session. It's been really exciting and lots of things to think about, lots of resources that are already being put in place, lots of research that is coming to the forefront to give a lot of credibility. And as we wrapped up with Nigel, investors, I really do like this statement that investors are looking for a direction of travel with regards to transition finances and acceptance. It's new, but at the same time, there's a willingness to have a shared vision to support this. So just like we'll just go around the final comments and then we'll wrap up before we go to the final session, to the break. So ladies first, I'll start with Vicky, if that's okay.
Thank you, Dio. And once again, I think it was a great discussion and insights into how South Africa is thinking about their role. For me, the last thing is to say that we're launching collective impact coalitions to get around what is needed to really drive the next steps in this just zero transition. We're launching this officially at COP, but then also looking ahead for COP next year, which is hosted by the African continent. So definitely would like to invite anyone who wants to engage with us, please get in touch and see what your role could be in driving collective action and impact going forward. So thank you for that.
And I thank you very much, Vicky. And I believe that there's a link that will be shared where the audience can find the details of the company's performance. So that will be shared in the link. Thank you very much. Repurposing.
Great. Thank you very much, Dale. So in terms of closing comments, I would emphasize that I think South Africa transitioning to a lower carbon economy and building climate resilience is really a great tool for driving competitiveness. It's something that's responsive, but also something that is also ambitious and can really set us up for the future. So it's quite key. What we do need is some level of granularity in terms of understanding which key assets exactly in the country we need to be targeting, as well as understanding what sorts of finance we actually need that will work for the country, and we're able to then build in all of those other elements of inclusion and equity, which are really quite key. So I think one of the other things that I would mention is that I think we've seen a really good example of how very clear leadership from the top and in particular for business has been able to contribute to driving a more ambitious approach for South Africa. So what we've seen post the study is an increase in South Africa's ambition through our nationally determined contribution. And we'd like to see that continue, but it does require quite considered and cohesive planning that's informed by facts and really good analysis, as well as collaboration across different stakeholders.
Absolutely, absolutely. Thank you very much, Repurposing. Mandy.
Thank you, Deo, and thank you to all my fellow panelists. I think it's been an extremely good discussion. So from our perspective, we're also planning on announcing this ESCOM facility and some of the repurposing work at COP26, to put on the table a practical example from South Africa on how you can implement a just transition. So, like I've said earlier, we don't have all the details worked out. We don't have, the final picture of what it all would look like. But we've got to start somewhere. So I'm very keen for us to get some implementation going on the ground, because the reality is, from an ESCOM perspective, for example, we are shutting down plants already. We already have social impacts to deal with. And so it's great to continue the discussions, but in parallel, we really need to start with implementation, and that is what we are very keen to do. Thanks, Deo.
Yes, absolutely. As right from the beginning, Vukile said, the transition is already here. Thank you. And Nigel, to round us off, thank you.
Yes, I think again, as Mandy says, thanks to everybody for participating and all my fellow panelists as well. But this is a real opportunity. I think there's an opportunity for us to catch up globally. There's an ability for us to overlay financial strategy and sustainability strategy. And I think that's really what's important about this. We really need to just get started. So, I think everybody expects that this is a fully understood, exact science. It's not there yet. You need to get started, and you need to be on the journey. You can't expect to win the race without being in the race. So that's my view. And we're obviously happy to assist where possible if anybody needs some assistance. But I think the main theme is let's seize this opportunity.
Absolutely. And, as they say, you can't expect to not get wet if you swim, right? So thank you very much, everyone. Really enjoyed the session. Really enjoyed the insights and also the tools that are there. I'll now hand over to Louise Gadina. Thank you very much.
Thank you so much, Dio, and very good morning to everybody. And thanks for your patience as we manage the various disruptions due to load shedding. I'm particularly pleased to see how resilient the organizers have been and the speakers, so thank you for that. And for a very practical session, panel discussion, thank you to the speakers, Mandy, Vicky, Nigel, and Repurposing, and thank you to Dio. We will now be taking a 15-minute short break before we start the next session. So if we can just ask everyone to be back here at 11:15, and we'll be having a very interesting discussion with Sean Kidney from the Climate Bonds Initiative and fellow panelists around the transition label and how do we make it credible. Thank you.